Ladies and gentlemen, my name's Scott St John and I look after the Credit Suisse franchise in New Zealand. Our speaker today became Minister of Finance of New Zealand late in 2008, a time I'm sure you'll agree was a tricky time to become a Minister of Finance. His first budget early in 2009 made for somewhat sobering reading, but in it he laid out a plan of gradual fiscal adjustment and aim to restore fiscal surpluses whilst taking the sharp edges off the recession for ordinary New Zealanders. Then in February 2011, we had a devastating earthquake in our second largest city, Christchurch. Aside from the obvious human tragedy, this made for a rather large one-off fiscal hit. However, today, 5 years on from that first budget, we're close to fiscal balance. Employment is rising, business confidence, migration and consumer confidence are all at recent highs. We have a free trade agreement with China and exports to China are increasing at a relatively rapid rate. And the rebuild of Christchurch and strong migration figures are seeing the construction sector growing strongly. Also, we're winning Grammys. So yes, ladies and gentlemen, New Zealand is a groovy place. The sun is shining, the olive harvest is coming in early, and the winemakers are about to have their largest and best vintage in history. So New Zealand is a great place to be at the moment, and it's my great pleasure to introduce our Minister of Finance and our Deputy Prime Minister, Bill English. Told you.
Scott. Well, thank you very much, Scott. It's a challenge to be sandwiched between the sessions on the US economy and on India. So you will decide for yourselves whether we're meat in the sandwich with more substance or whether we're a bit of light relief from our larger, more complex economies. One thing we have learned in the last couple of months is that if you want to get attention in world capital markets, put your interest rates up before everybody else, and they start taking notice. So I want to tell you a bit about a bit of the New Zealand story today, partly for its intrinsic merit, but partly because we are a small open economy influenced by the decisions made in much larger economies. And a key part of our strategy is to be resilient to all those waves that wash up on our shore generated by markets across and policymakers across Asia and Europe. As Scott has indicated, for a developed economy we have reasonably good growth prospects. We're looking at 3% plus growth over the next couple of years and maybe one more year after that. We're moving our management and our policy focus from managing recovery or recession and recovery to managing the growth phase. And in doing so, our aim is the holy grail, of course, and that is sustained growth. We have cyclical influences that are working for us at the moment, but in the face of uncertainties with China, a bit of a pause in Australia, some uncertainty in emerging markets, we want to focus on those things we can control and stretch out the growth phase, partly in order to assist New Zealanders who have been through a recession and a reasonably low income growth period over recent years. I thought I'd talk quickly about public finances, then a bit about what we're focusing on to manage our own growth cycle, issues which are reflected in pretty much every other developed economy who are just a bit further behind in the cycle than us, and then about what we're doing to lift our longer term structural potential. As Scott said, we'll be one of the few developed countries with a fiscal surplus in the next year or so. We have a budget on May the 20th, and it will almost certainly show a fiscal surplus for the 14-15 year. We set that target 4 years ago in conditions where we had a fiscal deficit that peaked at 9% of GDP, driven to a significant extent by financing the earthquake rebuild. We have focused on the long-term drivers of our fiscal exposures. The model generally, in the light of the GFC, has been governments making considerable savings. That works if those savings are made intelligently. Our experience from a similar exercise in the 1990s is that political pressures undo fiscal consolidation pretty quickly if it's not done well. In fact, BCG have done a global survey of this and make the point that really only a couple of fiscal consolidations in the last 20 years have been sustainable. So we have focused on sustainability, and that is getting in at the drivers of our welfare, long-term welfare costs, long-term education costs, long-term costs of the criminal justice system. We're using a forward liability model, so intellectual property from the insurance industry, applied to pay-as-you-go spending systems in order to focus our activity on reducing long-term costs. And the model, as we apply it to long-term welfare dependency, is yielding very rich insights and gives us confidence that the current fiscal consolidation will be able to be maintained with public support for it. That theory will be tested in the next 6 months as we run into a September election after 6 years of austerity. We're in reasonable shape for that election, which indicates some success, at least, in bringing the public along with successful fiscal consolidation. At the same time, with our public finances, we've focused on the management of the government balance sheet, and we probably now have the most transparent public balance sheet in the world. The banking collapses in the Northern Hemisphere and the threat of those contingent liabilities all around the world should have made governments much more aware of the full gamut of risk that sits on their balance sheet. We have systematically set out to bring those risks to the surface. Some of them have surfaced themselves, such as the Christchurch earthquakes, where we have had to put up about 7% of GDP as our government contribution to the rebuild. The rest, the other 13% coming from reinsurance. So we're setting badly managed balance sheets absorb large amounts of cash, which pushes up public debt and generates very inefficient operating expenditure. So again, we have a bit more confidence in our fiscal outlook because we are managing the capital demands of government much better. So our public finances are in about as good a shape as you could expect to find in a developed country. We've had the huge benefit of not having problems with our banking system, which means we've got very manageable levels of public debt. Our government debt will reach around 26% of GDP, that's net debt, and will start dropping in 2 years' time. Alongside tidying up public finances, we are moving to manage the pressures of a growth cycle, which is ahead of most developed countries, as illustrated by the recent increase in interest rates. And the issues that we will be setting out to manage mirror issues in developed countries across the world. We have particularly focused on learning the lessons from the last cycle up to 2008. In that cycle, our mortgage rates for homeowners exceeded 10% by 2007, under conditions of a fast rising housing market, rapid credit growth, and a very significant increase in government expenditure. Nominal government expenditure grew by 50% in the 5 years up to 2008, a pattern similar to many other developed economies. So as we look ahead, we've focused on two factors we believe are important to achieving management of the cyclical pressures on our economy. The first is to focus on flexible supply in our housing market. Other developed economies like Australia and the UK have needlessly expensive housing markets which have driven household debt levels to the highest levels ever. New Zealand is exactly the same. We are focusing now very heavily on the regulation of supply into the housing market because we need to get more flexibility, and in the long run we need to ideally lower the value of housing relative to incomes and therefore lower the pressure on household debt. In New Zealand it's particularly important because we have significant fluctuations in our migration flows. A very steady inflow, but our outflows fluctuate in direct proportion to the growth differential between Australia and New Zealand. Because that growth differential has reversed quite significantly over the last 2 or 3 years, our outflow has slowed right down, and that's putting considerable new pressure on an already fast rising housing market. We believe that we've got the political environment appropriate to make some significant gains in essentially deregulating the supply to our housing market. The second factor we're going to focus on is maintaining ongoing fiscal contraction. In the run-up to the election we'll have in September, rising interest rates will be a significant political issue. The best thing we can do to assist our central bank is to avoid the natural, obvious and regular temptation to pro-cyclical fiscal policy. It'll take some doing because we need to persuade the public that they can have better public services while we have contractionary fiscal policy. In the last couple of years we've managed to win that argument and we want to continue to do so. This will of course assist the government get its debt down faster, but just as importantly prevent the excesses of the last cycle with very high interest rates and an even higher exchange rate. So those are the factors we're going to focus on for managing our way through the cycle. Thirdly, I'll just come to our structural potential. One of the very notable features of policy discussion over the last few years has been a necessary but almost complete focus on central banks and their actions and the market and policy makers' assumption that if any further holes develop in economies, then central bankers will fill those. It's created, I think, among policymakers a bit of a complacency that growth is something done by Mrs. Yellen. In fact, it isn't. Our long-term structural potential will not be determined by our central bank. It will be determined by the ongoing quality of our microeconomic policy, real businesses making real productivity gains, selling real products to real consumers. Through the last few years, we have developed an ongoing pipeline of microeconomic reform with public support. So a couple of features of that have been the development of the macroprudential toolkit for the Reserve Bank, which was discussed at an earlier panel here. That toolkit is couched within a formalised arrangement that determines the decision-making rights between myself as Minister of Finance and the Reserve Bank. A second reform has been significant tax reform a couple of years ago, where we reduced income taxes and increased indirect taxes. We now have the third lowest tax wedge on labour in the OECD. Only Chile and Mexico are lower, and we increased our indirect taxes to GST to 15%. By the time it was implemented, it had pretty broad political acceptance. We've also almost completed in the next couple of weeks a privatisation program of energy businesses owned by the government, which we've sold down to 51% government ownership. One particularly interesting exercise has been our move to regulate our larger economic zone. New Zealand has an smallish oil and gas industry, which has existed for 30 years in one basin in our economic zone. There are over a dozen other basins which could yield oil and gas. In combination with some pretty vigorous promotion of these opportunities and environmental regulation, which now covers the ocean out to the 200-mile limit, we've been able to attract significant global oil and gas explorers, such as Woodside and the Norwegian Statoil company to New Zealand for oil and gas exploration. We'll continue with that type of microeconomic approach to lifting our growth potential. There is plenty more to do. In particular, we know we need to wrestle with our regulatory settings, some of which are now out of date, some of which have been overreactions to the global financial crisis, all of which need to point towards better conditions for investment. We are rated by the OECD as generally having pretty high-level institutions, but when you're a small, distant economy, the payoff for sound institutions is relatively low, and ours have to be excellent, not just very good. We're pretty optimistic about where we can get to over the next 5 to 10 years. Increasingly, we see the market differentiating New Zealand from Australia, where in the past we've been lumped together, and often New Zealand, Australia and Canada as you go further back in the economic cycle. We are locked into or exposed to the Chinese consumer cycle rather than the investment cycle. We know there is uncertainty around Chinese growth, but when we look at our production capacity relative to the size of Asia-Pacific markets, we think we can continue to do fairly well even if growth rates slow down, simply because of the size of the increment of consumer demand coming to market every year that incomes continue to grow. And that's been very evident in the sharp rise in dairy consumption and prices for our products in the Chinese market. We're also confident because the New Zealand environment has become much more resilient. We've been fighting headwinds for quite a long time now. The exchange rate has been elevated well above 30-year averages for 6 or 7 years. So those businesses that have survived that process are productive, resilient, export-orientated businesses. And they have managed to continue growing despite the headwinds. So on the basis of that greater resilience and a better kind of national confidence, we believe that we could be entering a period underpinned by Asia-Pacific growth and the recovery of our traditional markets, a period of sustained growth that will lift New Zealand incomes after a recession that dragged them down. And we look forward to the kind of capital formation process that will underpin it. We will certainly be setting out to create the best conditions for investment that you could expect to find in a small open economy. And the search for opportunities there, I'm sure you will find rewarding. Thank you.
So we'll take questions from the floor.
Thank you, Mr. Prime Minister. New Zealand has always been my favorite country. As a matter of fact, I wouldn't mind retiring in your country. But my question is, the budget deficit and your trade deficit, could you give us some color in terms of the trend going forward compared to your counterpart in Australia, for example? How is that improving? Or
Australia's going to have got a pretty challenging budget coming out in the next month or so. I mean, the way to think about it is they have only just slowed down, whereas we had a pretty sharp recession in 2009-10. So our revenues dropped sharply then. We've contained our expenditure to less than 1% growth, in fact less than 0.5% growth through the last 5 or 6 years. And so we're getting to surplus because as our revenues are recovering and we essentially hold expenditure flat. And the trend for that looking forward is pretty positive. I mean, within 2 or 3 years, we'll be generating surpluses of 2 to 3% of GDP. With Australia, their revenues are only just dropped in the last 12 or 18 months, and they simply haven't had the need to work on the expenditure side at the federal level. The state governments started a couple of years ago. So I'd imagine that they will, within 4 or 5 years, they will be getting back to budget surpluses. Bear in mind, Australia had almost no government debt until recently. We had low government debt, but it was about 8% of GDP, I think, in 2008. Australia's was essentially zero. So they've got plenty of room on their balance sheet.
Good afternoon, Prime Minister. A couple of years ago, The Economist issued a paper on the safest geopolitical country in the world. And the bottom line was that New Zealand is the one. And the explanation for that was that it is, for the most part of the world, so strategically irrelevant and so far away that nobody would sort of try to attack it or even become a terrorist. Would you agree with this statement, or can you add something more useful to that?
Well, I live at the bottom end of the most isolated country in the world. Well, our best protection is all that desert in Australia. They get pretty thirsty trying to get from the north end to the south end of Australia before they get to us. But look, I think it's pretty obviously geopolitically incredibly protected by its geography. And we find that increasingly people who are looking for a bolt hole actually come to my electorate, which includes Queenstown, and build very expensive homes and turn up for 3 or 4 weeks of the year, which is just fine with us. I wish I'd bought the lawnmower shop. And we'll continue to maintain and improve the institutions that make that attractive. It also means we are in a bit of a unique position for managing the relationship with the US and with China, which is pretty important to us. Both are very important to us. And it's a bit easier for us than, say, Australia, partly because Australia has something China really wants, which is iron ore. And, we're just a bit smaller, harmless, a bit friendlier. And that's an advantage we have to cultivate. I mean, there's a lot of disadvantages with being small and distant, and we have to work very hard on the advantages. And how that plays out for our future prospects has been, for instance, through free trade agreements. So we've developed a bit of a specialty in securing free trade agreements. For instance, we're the only place in the world that's got free trade agreements with mainland China, Taiwan and Hong Kong. Just recently signed up the Taiwanese one. We've been a big advocate of the TPP, in fact one of the originators of it with Singapore, and it's that kind of neutral push that's been enabled it to get the momentum that it has, but now of course it needs political leadership from Japan and the US to make it happen. We can't quite carry the weight to push it through.
Just concerning your analogy about foreign people buying big houses and staying 3 or 4 weeks a year, what is your policy in foreigners buying rural properties where they may not even live there but employ lots of New Zealanders and try and make the industry more efficient? There seems to be a difference between emotion and the financial reality. Could you comment, please?
Yeah, we have some restrictions around buying what's called, in our legislation, sensitive land, and that includes all rural property. So people can buy it, but they have to meet criteria that indicate they're a better buyer than a New Zealander. That doesn't prevent them doing it. We had, I know in my own area, a German family fund came in and bought quite a number of farms. There's Shanghai Pension was involved in a very high profile purchase in New Zealand, but they've followed through with quite significant investment in the dairy industry in New Zealand. So it's politically sensitive, a bit difficult, but it can be done. The effect of those restrictions, I think, is that it directs investors more to investment in the processing of the primary production. It also directs them into what's actually a whole other world of investment of opportunities they don't necessarily see from abroad. When you get into New Zealand, you find these small but deep pockets of expertise in businesses that have had to work out what their sliver of the world market is. And some of those have real potential as well. With respect to farmland, I can just reflect on my own experience. It's regarded, now as a bit more of a strategic asset than it used to be. Over the last 30 years, there's been several cycles of corporate purchase of land in a market that's dominated by owner-operators. All of them have eventually disappeared because the cash returns are simply too low. They're bidding against owners who will settle for 0.5% return on capital. And once the novelty of the scenery has worn off and the trips start feeling a bit long to get there, we found, this is just not my advice, it's just the experience of history, that corporate and offshore owners don't live it and love it, so they can't make it work in the long run. So,
just on that point though, that isn't that part of the problem with, say, farmland, is that it's really the capital gain as opposed to the actual day-to-day running. And I guess, could you maybe comment on the opening up of the public markets as a means for investors to be able to get access? Obviously there's been Fonterra, First NZ did Synlait Milk, so I mean there are some opportunities, but it seems sitting here you actually can get better exposure via the Chinese consumer story through either listed stocks in Hong Kong than you can really through the New Zealand capital market.
That's a very good point. It is quite difficult to buy into the New Zealand end of that Chinese consumer story. I think it'll change, it'll evolve and change in a way that makes it a bit easier. Just remember the history here. Our capital formation processes in New Zealand have been defensive for a long time. Since about the early 60s, when the UK joined the European market and we lost our automatic customer for everything that had built up in the post-war period. And New Zealand kind of hunkered down for a generation. And so its main capital formation processes have been family business, running off retained earnings and bank debt, and cooperatives, which are designed to stop people investing in your industry. And the public capital market has historically been one of the smaller ones relative to GDP. I think that's starting to change as people get a sense looking ahead that we are now in a world where people want our products. They're getting more growth orientated because they've come from a world where people didn't want our products. We were trying to sell butter against the European butter mountain, wine against the European wine lake, anything else against big tariffs on agriculture. So that's why it was defensive. What I think we're starting to see is a shift from a focus on control to an understanding that to get growth of a type that's relevant and possible in this much more positive environment, you need to access other people's capital, whether it's someone who's got a supply chain or a distribution system in Indonesia, or can take your little bit of technology straight into a large corporate in India, or the complex Chinese market, which we all grapple with. Then openness to other capital is important. The public market, one of the reasons we did our privatisations was to bulk up this relatively small public market and get another tranche of investors back into it who've been away since the late 80s with the share market crash. And the indications are that it's starting to perform more of the role it should be performing of just matching providers and seekers of risk capital. One of the unexpected benefits of it is we've seen a slew of IT-related floats, and more of them to come, led by the flagship of Xero, which they assure me is going to be the Microsoft of business accounting. It's now worth $4.5 billion or something like that. So more of that's going to make our capital markets more attractive to external investors.
Sure, you had a question.
Yes, I was in New Zealand for the first time ever in January. Beautiful country. Two questions I have. One is regarding labor minimum wage. It seems to be one of the highest in the world. I mean, Australia and New Zealand as well. And given that, and also the labor laws are quite draconian compared to the United States, how do you attract investment there? Well, that's my first question. The second is that the locals say that things that are produced in New Zealand, like lamb and wine, are more expensive in New Zealand than Hong Kong or the States. So how does that happen? Is it currency, GST? Could you just address those two issues? Thank you.
Okay. In answer to your first question, I wouldn't agree that our labour laws are draconian. They're significantly more flexible in Australia, for instance. And we have found through this last recession, the labour market has been flexible and accommodating of the way the real world has been, to the extent that while you didn't see absolute cuts in wages on a significant scale, you saw a lot of paring back of working hours from a labour force that wanted to keep its jobs, and they did. So it's proven to be pretty resilient under a lot of pressure, more than a number of other countries. You're right about the minimum wage. It's relative to the average wage, it's one of the higher in the OECD, and that is a product of a reasonably egalitarian country. In fact, it's just gone up by about 2% next week. I think 1st of April it'll go up again. That's not going to change. So anyone who comes in needs to get used to a reasonably noticeable minimum wage with very broad coverage. Okay, it covers everybody, not just those who are unionised. Union penetration in the private sector in New Zealand is only about 8 to 10%. It's quite a bit higher in the public sector. I don't know why it costs more to buy a leg of lamb in a New Zealand supermarket than a Hong Kong one. You could blame the supermarkets, but I wouldn't possibly dream of doing that. But I know it irritates the hell out of New Zealand farmers and has for a generation. Whatever it costs, it's worth it.
Sir.
Yes, New Zealand is an incredibly underestimated country, and in dairy you blow everyone away. There's not one country in the world that I think that maybe the US, but exporter. That's not even counting your rugby, and that's not even counting that you should have won the America's Cup. You were 8-1 up. Anyway, and you gave them the lay day that you shouldn't have given them. Anyway, in terms of dairy, it's well known that 25% of the farmers in most make 80-90% of the profit. You take that in dairy, you take that in grains, pretty much. So the best farmers, the 25, are very good, and the 50% of the farms break even or make a loss. So you continuously want to try and persuade the better farmers to increase scale. Now, New Zealand's done that very, very well over the last 10, 20 years. But you need to continue lifting your game. Now, you produce double the amount of dairy, 20 million tons, versus Australia is gone backwards from 10 to 9.5. Don't tell the Australians. Anyway, but at the end of the day, if you want to move to continue that story, you're going to have to try and find ways of, everyone's trying to look at agricultural investment and how we can invest in agricultural farms. We're looking at one model of trying to identify the 25% of farmers who are the best and trying to invest in them so they can buy the neighboring farms. What other models have you looked at in order to do that? Or is it Frontiera, or is it the banks, which are, maybe you've got cleverer banks which lend better to your farmers? What do you do in order to inject more equity? And how do you make them grow? What have you done?
Well, look, I wouldn't point to anything specific that government has done. You're talking about a farming industry that has been without any form of subsidy for now coming up 20 years, and relatively minor forms of subsidy for the 10 years before that. So they've got pretty good at it themselves. And coming from one of these areas, I've seen two rounds of transformation just in a 20-year period. So we would generally leave them to it. With respect to rationalising around size and scale, it doesn't, but there's scale can be a bit of a misleading fantasy. With our kind of farming systems, it doesn't take long to get too big to actually be on top of the production because of the nature of that production. The other point I'd make is that there's a lot of opportunities for investment around it. One of the misunderstandings about the dairy industry in New Zealand, and in fact other industries there as well, is that they're defined as commodity producers. But of course a commodity these days is wrapped round with all sorts of knowledge-based investment, whether it's the genetics. I mean, one of the keys to New Zealand dairy is not just water. Essentially it's a water export industry. It's one way to look at it. Let's put a bit of colouring in it and it's off. Is the genetic, 30 years of genetic selection that sits in behind it. And that's very valuable intellectual property. And that's before you get to all the production systems. And as we know, when anyone suspects those have gone slightly wrong, as we saw last year, that can have a huge value impact. So now we understand how valuable that bit of the process is. And those right along that chain, we need investment. In a way, buying the farms is the sort of simplest bit. A lot of the added value is pre-farm and post-farm. But we leave them to it. I think the last thing New Zealand farmers would want to hear is that the government's got a scheme for helping them.
Madam.
You had mentioned about the deregulating the supply of housing. And I'm curious, could you elaborate on that and talk about what the impediments from a political perspective to doing it are?
Okay, look, one of the striking things about housing markets across the developed world is the similarity in approach by the planning and urban design community. And there's a couple of features of that. There's a number of features of it, but one feature is an almost willful ignorance of the economic impact of what they do. So this fashionable view is that you try and densify your cities. The big flaw in that is that people who live in those cities generally don't want them densified. So you end up with planning restrictions that prevent cities growing out and political restrictions that prevent them growing up at a rate that is sufficient. So your leafy suburbs don't like 10-storey apartment blocks suddenly appearing in their street, but planners assume that that can happen. And so they've lived with these contradictions for a while, and the result of it is overvalued housing markets that are more volatile as well than they need to be. So we've engaged in a pretty intensive discussion with the people who make those rules, given ourselves some legislative coercive tools that we use if we need to. We are trying to expand the supply of land fast enough to shift expectations in the current property cycle. And I think we'll start having some success in the next 6 to 12 months. We want, our rules have been the same as Melbourne, Sydney, all the expensive places around the world where there's huge discontinuities in land price around urban boundaries. People who sit there, developers who just sit on land because they can see their margins growing and growing. We're starting to get a market where they think they need to get moving, otherwise they'll lose their margins. But the long run game is a property market that can breathe in and out with quite big fluctuations in demand. Planning fashion has stopped that, and it's time we got a bit of sensible economics into it. There's a couple of other motives which apply to every other government, not just us. Governments are very fiscally exposed to high-priced housing markets. A fair bit of our income transfer system is about two-income households who've reached the limit of the debt they can service, so governments have had to increase the transfers, and that's particularly the case in both Australia and New Zealand. And it's quite coincident with the last housing cycle. And then, of course, there's the ongoing inequality argument, because income inequality in a lot of developed countries hasn't deteriorated that much, but the wedge provided by insiders and outsiders in the housing market is getting bigger all the time, and governments will be expected to buy that out sometime. You can just feel it coming. Well, we want to get ahead of it and actually fix the core problem rather than buy it out on the demand side.
So have we got one last question?
Hi. I personally love New Zealand as a country as well, but most recently it's getting a little bit more expensive for me. And if you look at the Kiwi Twi, which is actually, I think last week was trading at the highest point since I was very young, like 30 years ago. So, actually, as far as I understand, probably around 15 years ago, the Kiwi Twi was actually part of the factor for your policy to, RBNZ's policy too. And right now it's not written there, it's different right now. But how does a very expensive currency relative to Australia, relative to the rest of the world, affect your policy mix? Or does it affect it, or how does it affect it, or does it constrain it somewhat?
Well, hopefully what a very expensive currency does is drop in value, and that would help everybody. So, we think it's a bit expensive. We don't, as you say, it's at the highest levels it's been in a long time. For humble politicians, we get this contradictory story. The ratings agencies, who of course aren't well known for perception, tell us that we're on the edge of some sudden stop event, and investors worry about that, and therefore we've got to be very careful about how to maintain our high credit ratings. The market keeps telling us that despite the fact we've got current account deficits, our currency is worth more and more, not less and less. So our attitude is we can't influence it directly. There's a handful of places who do. They tend to be not quite democracies, and they tend to have a couple of $100 billion in the bank, US, and we don't have either of those. So we don't pretend that we can do much with the currency. We just focus on our domestic competitiveness. My guess is over the next few years, you will see, as the US normalises and Australia sort of gets through a bit of a pause and gets going again, that you'll get back to something like the normal and pretty obvious rating based on fundamentals, and that is the US and Australian economies are bigger, stronger economies, and their currency should be strengthening. And while we've done pretty well, we haven't done enough yet to warrant having a relatively stronger currency compared to them. We hope in the long run to achieve that, but it looks a bit overrated at the moment. Mind you, we've got to go through this phase. We've just put interest rates up. Okay, everyone gets excited about that. But, you know, we take a longer view and it will re-rate.
Well, ladies and gentlemen, I think we might call it a day. Thank you for your attendance, Minister. As always, interesting and illuminating. If you could join me in thanking the Minister for his presentation.
Thank you.